Welcome to Absorption and Variable Costing, Part 3. This applet is a continuation of Absorption and Variable Costing, Part 2. By the end of this applet, you should be able to prepare an income statement using variable costing. We'll continue to use Jenga Inc. as our example. Here's the data from Part 2. Our objective is to prepare an income statement using variable costing. We'll start with the usual 3-line heading, company name, report title, and date. The only new thing here is that we'll identify the costing method in the report title, so income statement dash variable costing. We'll use 3 number columns for our income statement. Keep in mind that the first number column is for detail amounts, while the columns to the right are for subtotals and totals. When we're finished, you'll find that the values in the third column are the same values we would use in a basic variable income statement. These are the most important values in the statement. Every income statement starts with revenue, sales in this case. When you calculate the sales amount, be sure to use the selling price per unit times units sold. So $360 per unit times 25,000 units is $9 million. Since this is one of the key values in the basic income statement, we enter it in column number 3. Then, because we're using variable costing, which organizes costs based on behavior, we set up a section for variable costs, except now that we're preparing a formal income statement, we'll use the term variable expenses. To emphasize the big picture here, we'll enter the section total label now. This is to remind you that every expense in this section has to be a variable expense, and every variable expense that Jenga has for the accounting period has to be reported in this section. The primary organizing factor is cost behavior, but we also need to separate manufacturing from non-manufacturing expenses in this variable section. So we'll set up 2 subsections, each with their own total line: variable cost of goods sold and variable selling and administrative. Now we can enter the pieces. We need to calculate variable cost of goods sold by running through the inventory cost flow pattern. Start with beginning inventory. We're told that this is 0. Then we report costs added during the accounting period. Keep in mind that we're working in the variable expense section, so every cost you include must be a variable cost. Our variable manufacturing costs are direct materials, direct labor, and variable manufacturing overhead. The calculations for each of these variable costs are cost per unit times number of units produced. We combine beginning inventory and the cost added to get variable cost of goods available for sale, $10,668,000. Notice that we enter this amount in column number 1. You'll see why when we get the variable expenses section completed. Before we can subtract ending inventory, we need to calculate the amount. Start with figuring out how many units you have on hand at the end of the accounting period. You started with 0 units, produced 42,000 units, and sold 25,000. So we have 17,000 units left on hand. And each of the units cost us how much to produce? $254 each, since we're using variable costing. Our ending inventory cost is 17,000 units times $254 per unit, $4,318,000. Variable cost of goods available for sale, $10,668,000, minus the cost of ending inventory, $4,318,000, gives us variable cost of goods sold, $6,350,000. Notice that we enter this value in column number 2. The reason is that we want both subtotals for variable expenses to show in column number 2. At this point, we've reported all of Jenga's variable manufacturing expenses, but we still need to report the variable non-manufacturing expenses before we can close out the variable expenses section. When we check our data, Jenga has only 2 non-manufacturing costs: office rent and commissions expense, and only one of these is variable. The commission expense amount will vary depending on the number of units sold. So we can enter commissions expense in the variable selling and admin section. The calculation is $41 per unit times 25,000 units sold. The result, $1,025,000, goes in column number 1. The total for this section goes in column number 2. Now you'll be able to see why we put the totals for our 2 variable subsections in column number 2. It makes it easy to add the totals for the subsections to get total variable expenses, $7,375,000. Since this is one of the key values in the basic income statement, we enter it in column number 3. Focusing on column number 3, we take sales, $9 million, minus total variable expenses, $7,375,000, to get $1,625,000 contribution margin. Fixed expenses come next. When we check our data, we find 2 fixed costs, fixed manufacturing overhead and office rent. Both are already in dollars, so no calculations are needed. Just pop them into the fixed expenses section and enter the amounts in column number 2. Then label the total fixed expense line and enter the total amount, $1,160,000, in column number 3. Focusing on column number 3, contribution margin $1,625,000 minus total fixed expenses $1,160,000 equals $465,000 of operating income. Make a note of this variable costing operating income. We'll compare it to the absorption costing operating income in the next ACLET. This concludes the ACLET, Absorption and Variable Costing, Part 3.